Howdy, Jacob here. Today we're looking at Kforce in the professional services industry. 1.2 billion market cap, slightly higher enterprise value, with growth very low in the low single digits, low to mid single digits in the last 10 years, from 1.2 billion in revenue to 1.5 billion, with gross margins down a little bit, but operating margins up a little bit. And return on invested capital does look amazing, but with some of the other professional services industry companies, they just don't need a lot to invest in. They get a lot of money from their investors, and so it's not difficult to show a high return on invested capital, especially based on the fact that their use of cash is really just paying a dividend and buying back shares for the most part. Not a lot of reinvestment opportunities unless they're making acquisitions of other professional services companies that can maybe make their business more efficient, something like that. But um, that's the initial review there, with 0 billion on the balance sheet and 42 million long-term debt. I mean, again, like anything, I'm not concerned by just one thing, but to have 0 million in cash for a $1 billion company just seems ridiculous to me. And again, I know the company produces the last 5 years of free cash flow has averaged about 70 to 80 million. And so, I mean, they have way more than enough for this long term debt to really be scary. But as a percentage of 5 year average free cash flow, it's nothing. But to me, I always like to have a little bit of cash on hand just for liquidity purposes, thinking about downside risk. Again, it's not necessarily the most advantageous use of that cash, but it can really help you out in situations that you can't necessarily predict. It's the same with having insurance. I mean, why do people have insurance? It's for those things that they can't necessarily predict are going to happen. That worst case scenario might actually happen. And so to me, that's like having cash on hand, gives you a little bit of a cushion. And although they do have well produced positive free cash flow in in their recent and fair history, and same with earnings, I just prefer to have a little bit of cash on hand to be able to have that cushion in case that worst case comes to fruition. So to me, this isn't an immediate turnoff, but definitely a note to say, even for my own investment purposes, I like to have cash on hand. One, for cases if the company that I love and want to invest in dropped 50% over the span of 2 months, I really want to get into it, then bam, I have the capital to do so. But it's also for those worst case events, like my cars. I got in an accident and my insurance paid half of my vehicle, and so I have quite a bit of thousand left off, and I just have cash to be able to purchase I want to say new car, but not new car. New cars suck from an appreciation standpoint, but get a car that is reliable and everything. And so to me, I just like cash in hand. So long-winded answer of me just saying, like, balance sheet in respect to debt is probably not a big situation that I'd be concerned about, but not having that much cash on hand is somewhat concerning to me. I'd like having a little bit of cash on hand. It can't just all go out. There should be a little bit of a cushion. And again, they've performed positive free cash flow every year since 2014, but in or 2015. But in 2014, we see negative earnings, and so they would have had to go in debt, which we see that they did to be able to afford that. You wouldn't have had to fluctuate and go into this debt if you don't need to. Debt should be used for advantageous situations. Like, there's an acquisition that I don't want to issue a bunch of shares for because we're already pretty cheap in shares, or our stock price is already pretty cheap. I don't want to just issue shares, so let me issue a little bit of debt. It's not to just fund everyday activities, which, again, that's 2014, but God, I gotta stop long-winding these answers. But share repurchases is the main use of their cash flow, with their dividends paying out roughly 30 to 40% of their 5 year average free cash flow, which is 2.3%. So pretty solid yield there. And like I said, a lot of professional services companies are just giving their money back to shareholders through share purchases and dividends, which we are pretty much seeing here. There's not a lot of debt repurchases, but they just don't have a lot of debt, and then not a lot of reinvestment in acquisitions, so fairly common. Let's start making some assumptions here. I'm going to say on the revenue side, probably something like 3%. And then I mean, again, they're not reinvesting at those 20% rates of return. So I'd love to put a premium on there if they were to reinvest, but they don't have that. And so to me, it's just any other business, or it might not be any other business, but it's not a business that to me deserves a premium well in excess of market average. And it's actually, I think at the end of 7 years, might have lower growth in the market. So I feel pretty confident in sticking with that. And I'll do 4.55 for my margins. Repurchasing of shares, 1% of their market cap is about 12 million, 2% would be 24 million. Inclusive of their stock-based compensation, we're looking at about 40 million, 50 million. So let's say 2.5%. That would be about 70% of their 5-year average going towards that, and then the remaining 30% of this dividend. Well, actually, they've been increasing that dividend a lot more. So let's do 2%. That would be about 50% of their free cash flow, 50 to 55%. And their dividend currently paying about 30 to 40%. They've been increasing that pretty substantially. So let's increase that substantially as well. So that basically this is saying at the end of 7 years, their dividend payout is probably going to be closer to that 50% range, and their share repurchases will probably be pretty close to 50%. And so really it's not leaving a whole lot of money to acquire businesses or buy back shares, buy back debt. But historically, I have to balance out what I want them to do with what I've seen them done historically. And that gets me to a figure that still needs to fall just about 50% to get the return I'm looking for. But hopefully you enjoy the video. Sorry for the long-winded answers and the little annoyance on no cash. But again, any business is just like a person. If you had no cash on hand, but you were making millions of dollars a year, that's great. But you still have millions of dollars in debt. So if you were to get fired from a job, and obviously this is a business, but a business could, plummet fairly simplistically. Think about the financial crisis for a professional services firm. I mean, it just I could see it happening. So I do like a little bit of cash on hand, but overall solid business. And I hope you enjoy the video. Have a great rest of your day. Thank you.